The last time a 30-year U.S. government bond paid investors 5%, the global financial system had 12 months before everything broke. This week, the U.S. Treasury auctioned $25 billion in new 30-year bonds. The yield came in at 5.046%. That number has not appeared at a Treasury auction since 2007. Not once. Not at 4.9, not at 4.8. The floor held until now. Bonds are how governments borrow money. When a government needs to spend more than it takes in, it sells bonds to investors. Those investors lend the money, and in return, the government pays them interest. The yield is the interest rate. The higher the yield, the more the government is paying to borrow. And the more investors are demanding to compensate for the risk they are taking. Right now, investors are demanding a great deal of compensation. The question is this: is the smoke detector screaming because the house is already on fire? Or is there still time to find the source before everything changes? Here is what the public record shows. The U.S. government currently carries approximately $39 trillion national debt. The Congressional Budget Office, that is the government's own fiscal scoring agency, projects that interest payments alone will exceed $1 trillion in fiscal year 2026. Not total spending, not the deficit, just the interest, just the cost of servicing debt that already exists. To make that concrete, as of earlier this year, the U.S. Treasury was paying roughly $88 billion per month in interest. That is more than $22 billion per week. That monthly figure is roughly equal to what the government spends on national defense and education combined over the same period. Meanwhile, in Germany, which has its own deep fiscal debates, the conversation is about investment policy. In the United States, the conversation is increasingly about whether the interest bill can be managed at all. By the way, the immediate trigger for this week's spike is not a mystery. The U.S.-Iran war began in late February 2026. Since then, oil prices have risen roughly 60% from the start of the conflict and nearly 80% since the start of the year. The broad commodity index is now above the pandemic-era peak set in 2022. Those figures are not from an analyst blog. They come from a formal letter written to the Treasury Secretary by the Treasury Borrowing Advisory Committee, the U.S. government's own panel of bond market professionals. That same letter notes that inflation swap markets, the instruments professional traders use to bet on where inflation is going, have jumped by 75 basis points in the United States and 100 basis points in Europe since the war began. Before the conflict, markets were pricing in rate cuts by the end of 2026. They are now pricing in the possibility of rate hikes. By comparison, before February this year, central bank watchers across the developed world were discussing an easing cycle. That conversation has been replaced by a different one entirely. Consumer prices in April 2026 rose at an annual rate of 3.8%, the highest reading since May 2023. Gas prices are up 28.4% over the past 12 months. The national average at the pump is $4.50 per gallon, up from roughly $3.14 a year ago. These are not my opinions. This is what the public record shows. The record of official projections on this particular set of risks is worth reviewing carefully. Before the pandemic, official forecasters repeatedly signaled that low interest rates were a permanent structural shift. Borrowing was cheap. The assumption built into government budget plans was that it would stay cheap. That assumption shaped a decade of spending decisions. The record shows that assumption was wrong. The cost to ordinary Americans, interest payments that were $345 billion in 2020, are now projected to exceed $1 trillion in 2026, nearly triple in 6 years. The record shows that when inflation began rising in 2021 and 2022, the initial official characterization was that it was transitory, temporary, a supply chain disruption that would resolve on its own. Policy stayed accommodative longer than many economists advised at the time. The cost to ordinary Americans, the worst sustained inflation in 40 years, which has not fully unwound and which has now been compounded by an external energy shock. And the record shows that the bonds auctioned at historic lows during the pandemic, some 30-year bonds were issued at 1.25% in May 2020, are now worth less than 50 cents on the dollar. The buyers of those bonds, including pension funds and institutional investors, have absorbed enormous losses. The cost? Those losses are locked in for a generation. The bonds auctioned this week at 5.046% will be paying that rate until 2056. Wrong, not according to me, according to the numbers and their own record. The incoming Federal Reserve Chair was confirmed by the Senate this week in a 54-45 vote, the most divisive confirmation in Fed history. What the official framing said, the new chair arrives ready to restore accountability and confidence in the central bank. What that actually means, in plain English, the person now responsible for managing the most divided monetary policy committee since 1992 takes office on the same week that inflation hit a 3-year high. The 30-year bond breached 5% for the first time since before the last financial crisis, and markets began pricing in the possibility of rate hikes. The timing is, as I read it, a rather compressed orientation period. The numbers in full. Every one of these has a verified source. $39 trillion. That is the current U.S. national debt as of April 2026. $1 trillion. That is the projected annual cost of interest payments in fiscal year 2026 alone. Not principal, not programs, just interest. $2.1 trillion. That is where the Congressional Budget Office projects annual interest payments will be in 2036, a 106% increase in a single decade. That projection was made before the Iran war pushed yields above 5%, 19 cents. For every dollar the U.S. government collects in taxes and fees this fiscal year, 19 cents goes directly to interest payments on existing debt. Not services, not infrastructure, not defense, interest, 3.8%. The annual inflation rate in April 2026, highest in nearly 3 years, moving in the wrong direction, 5.046%. The yield on a 30-year U.S. Treasury bond this week. The first time that threshold has been crossed at auction since 2007 and 4. The number of FOMC members who dissented at the April meeting, the most divided the Federal Reserve's rate-setting committee has been since 1992. That is the committee the new chair walks into on June 16th. That is not a list of statistics. That is a Tuesday for millions of families across the United States, and the ripple effects cross every border. That is a parent filling up the car at $4.50 a gallon, buying groceries that cost 17.9% more than a year ago on energy-linked products, paying a mortgage locked to rates that reflect a bond market repricing nobody fully planned for, running the math at the kitchen table, coming up short, and wondering why the official story never quite matches the bill in their hand. Every other developed country lives on the same planet. Every other economy faces some version of fiscal pressure. Why is the gap between what is being promised and what is actually arriving growing wider, not narrower? Now, some in the media will tell you that following this closely makes you too anxious, too negative, too focused on problems and not solutions. Insert whatever framing they are using this week to suggest that paying attention to the public record is somehow a character flaw. But Canadians and Americans who have been paying attention already know what the data shows. You have been watching these numbers move for years. You have noticed that the official reassurances do not line up with the grocery receipt, the gas pump, and the mortgage renewal. You are not wrong. You are not extreme. You have simply been reading the public record and trusting what you find there. That is exactly what you should be doing. Every source used in this video is verified and linked in the pinned comment below. Check them yourself. The Treasury's own advisory committee wrote the letter about oil prices and inflation repricing. The Congressional Budget Office published the interest payment projections. The Bureau of Labor Statistics released the April inflation numbers. None of this requires interpretation. It requires reading. Tell me in the comments. When did you first realize that the official framing on inflation was not the whole story? Was it the grocery bill that moved first? Was it the gas pump? Was it the mortgage renewal that came back at a rate nobody had planned for? I want to hear from you, because the comments on this channel are one of the few places where that conversation actually happens plainly. Here is what is easy to lose when the numbers get this large. $39 trillion is not a real number to most people. $1 trillion in interest payments is not a real number. 5.046% on a 30-year bond. That is not a number that arrives on anyone's kitchen table with a bill attached. But the morning commute is real. The grocery run is real. The conversation between a couple at the end of the month, going through what came in and what went out, that conversation is real. The gap between those two columns is real, and that gap did not appear without cause. It appeared because decisions made in budget offices and central bank meeting rooms, decisions about what risk is acceptable, about what projections to trust, about what warnings to take seriously, have compounding consequences that eventually reach every household. There is a version of governance that takes those consequences seriously. That starts with the numbers as they actually are, not as official forecasts hope they will be. That treats fiscal arithmetic the way a household has to treat it. Honestly, with both sides of the ledger visible. That makes decisions about spending and borrowing with the knowledge that the bill arrives eventually and that it arrives with interest. That version is not a fantasy. It is just what responsible governance looks like. The smoke detector that has been going off this week is not new. The signals were there in the deficit projections. They were there in the debt to GDP trajectory. They were there in the gap between where rates were being held and where bond markets were pricing long-term risk. What is new is that the reading has become impossible to set aside. Every country that has ever had to reckon with the compounding weight of borrowed money has faced a version of this moment, a moment where the instruments that were built to hold the system together begin to signal that the system needs something different. What it needs most is honesty. What it needs most is governance that looks at the number on the page and speaks plainly about what it means. The data shows where things are today. The decisions made in the next few years will determine where things land, not for an abstract economy, but for the specific Tuesday morning when a family adds up the numbers. And this time, the columns balance. That outcome is still possible. It requires choosing it.